going to do a market review for the 14th of October. So we're having a look particularly at this week's price for Tuesday, Wednesday, and Thursday. Now, we had that consolidation on Tuesday and Wednesday. Wednesday was marked by two important high impact news events, both at 8:30 and 2 o'clock. And then we had that high impact news again on Thursday for 8:30. Now, there's something that I want to point out to people that I think is worthy of attention and worthy to note. On Wednesday, 8:30 and at 2 o'clock here is marked on our charts. Now, what seems to be happening lately with Bitcoin at least is it's become more and more sensitive to the traditional sort of market influences. So what I mean is these high impact events that normally cause volatility over in the currencies or in equities markets, they're having more and more of an effect on Bitcoin. This week has been a really good example of that happening. So you'll note here, even compared to the S&P 500, 8:30 and 2 o'clock. Now, a lot of people were expecting at 2 o'clock high impact, let's get some volatility in the markets, but the ES did pretty much nothing. But Bitcoin saw quite a bit of volatility, and also at 8:30, much more volatility than even the ES. Now, this to me is a little bit strange because this is not something we've seen before. The volatility is normally mirrored between the two, but I see now Bitcoin is really sensitive to this to these events, and you'll see today is another good example of that. We'll go into that a bit later as I'll talk through that. I want to talk about a little bit about yesterday and what I was thinking, because I did have a plan, and that plan was to see this fair value gap, this daily fair value gap, run out. Okay, this would have been part of a run up of the previous day high. And why I was thinking this is because we did have this nice period of consolidation, right? We're marked by the return to an equilibrium and the price moved out. Now, one thing to note about this was that it wasn't the move out of the equilibrium was not ideal, in the sense that there wasn't really a displacement. Okay, so you didn't really have an opportunity for a retracement and then reversal. This was very much, I guess, consistent with the overall sort of sentiment in the markets during the time. I mean, have a look at ES on that same period, how there was nothing really going on, right? So the volatility was really low. Nevertheless, it was still an idea of mine. Now, why I initially thought this is because I work on a certain principle. So one of the main reasons that I expected a higher move up, at least during Wednesday's trading, was because of this particular section of price action. So what we ended up seeing here was a lot of market shorts opening. Now, what generally happens is, and this is a principle I work with and why I work with CVD divergences and stuff like that, is because when we see the retail side of the market likes to enter through a market order, okay? You always got to think to yourself, well, who's actually buying up, who's trading the other side of these orders? So what happens is a lot of the times that these market orders don't even go to the exchange. So what the exchange will do, they'll send them to an internalizer or something like an off-exchange market maker, where they are trading then the other side of those retail market orders, right? So these orders are bought by an off-exchange market maker and trade against these orders. Oftentimes, these off-exchange market makers will have a lot deeper pockets than the retail crowd. So when they are buying up a lot of shorts, or a lot of market longs, they want to be aiming for the opposite side of what they are planning to do with it. So what retail will normally do is, if a high is put in like this, when you get that rejection from the high, you'll see lots of shorts going in at market, right? Because they think, oh, this is definitely the high now. This is definitely going to be the high. And oftentimes, and I'm sure a lot of you experience this phenomenon, but price will just seem to drift higher, even though your order flow suggests that that shouldn't be happening because people are shorting, right? People are selling, 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 but yet the market is not doing what you think it should be doing. Well, it's because someone else is buying all of those shorts, and that person that is buying them, or that company or institution that's buying them, has a vested interest in price going in the opposite direction, and they have more money than you do, right? And they are willing to see price go higher. So that's why I was expecting higher prices at the time. But essentially what you had happening is during this whole phase, when you have a controlled descent like this, something is up. Okay, there's a lot of liquidity building up here. And this is often exchange specific liquidity, as we will see. But there is going to be a lot of guys with their buy stops laddered at these equal highs and at these equal highs, and above obviously the swing high, and then back into that institutional order flow point of reference, the fair value gap on the daily. So anyway, what happened is price gravitated lower and started moving lower. That's fine, whatever. The next thing, an area I want to talk about, the next point of interest I want to cover here is this swing low, and then this move up here. So we'll have to go down onto a lower time frame. So the first thing you'll notice, you'll see that this wick here is grayed out. Then just above it is a red line. So I've just what I've done on this chart is I've overlaid a mark price, right? I've overlaid the mark price as presented by from the your BitMEX mark price. So this is obviously it's a sort of index price, so it's getting a number of data feeds from a number of exchanges and then sort of making an average, I guess. Now the idea is that mark prices are used to protect you from manipulation and unfair liquidations or whatever. So it is sort of like the true price, I guess. Okay. So you see here that on at least Bybit, the USDT pair on Bybit for futures, you have that big wick down. So this wick down here, anything below where the mark price stops, at least on a wick like this is going to be the market on the exchange at least running out liquidations. So when price retests it, oftentimes what you see is price won't retest the low, because that's not where the demand is. That was just liquidations being run out. It'll often just retest the last low created and put in by the mark price, and you'll see that happening here. Price moves down through the mark price, and then real demand is in that area. It's not down here, right? And you'll see something similar happening here as the price moves down here. On the exchange, at least, price was liquidating positions. But on the retest, it just retested the mark price, right? Because that's where actual interest is in buying. And now another interesting thing is you'll see a mark price during the manipulation here that happened just before that our impact news event. You'll see the mark price ends at 18949. Everything above is mass liquidation. The liquidation engine is running out high leverage positions on that exchange. The mark price is down here. Now, because of the system of arbitrage and cash and carry arbitrage, price will balance out. This is the true price, right? So what's happening is they're going to be, so they'll be buying spot and selling futures. Because of the price difference, then this will create an equilibrium. Eventually, it will factor out and sort of the prices will become similar through that process of arbitrage. So in line with some of the stuff that ICT teaches, we sometimes do get a Judas swing, right? So before at 8:30 during news events like this, while it's also running out liquidity on the specific exchange, it's also performing that fake move, right? And then at 8:30 on the dot, we get that prices, that aggressive repricing that gets us that liquidity void. So during all of this, it's not feasible really to. I don't think it's even possible to participate in this just because of the speed at which it's happening. Just a matter of note that this low here, this was actually this was our previous low, right? It's just below the previous low. So this is that range we've been working in, right? So from that high and that low, so this is the range we've been working in at the moment. So we do test the bottom of that one. So that's just a side note. So we'll go back here. So the next thing I want to do is I want to just point your attention to the formation of these. So we had that accumulation, price retests the sort of bottom area of it. So I'll show you the order flow here, which is interesting. Then we have an order block at this location. We have an order block here and one over there. So I'll just show you on Atis why these are considered order blocks and what we might expect to happen to price if it does revisit these areas. Okay, so let's go ahead and talk about the first section, which was the area of accumulation after we had that that high impact news data and the volatility thereafter. So you'll note here this is that period of consolidation accumulation. So here once again, what the first thing we notice, what does the retail crowd do? Well, they market shorting. Right? How do we know this? Well, open interest is increasing, CVD is making a lower low, quite obviously so compared to price, which is making higher highs. So retail is shorting this and someone else is buying it. Okay, and who's buying it? Well, it's off-exchange market makers. And what is their goal? Well, their goal is to push price higher. Why? Because they're absorbing the market shorts and they then want to distribute their profits higher. So you'll see as price retests this general area marked for accumulation, you'll see again that divergence. And then again a small one just before price makes it eventually starts moving up. Another important thing to note, and something that you need to consider, is that a rally or a trend reversal is not necessarily created because of, it doesn't start because of longs. It starts because of positions closing. Yeah, so that's what they call like short squeeze or long squeeze or whatever. That's how the trend changes. Initially, that's how it reverses, right? It's because of positions closing, not new positions opening, which is, and you'll see it here happening here. So when you have this sort of, when these tick charts look like this, when they when the opening is flatlining and the price seems to be just ticking back and forth like this, well, this is a visual representation of liquidations. Now, one way you can look for liquidations is you can go to Coin Analyzer. So just load up any Bybit, the Bybit USDT chart, and there's a you can add the indicator, liquidation indicator. Now, if, I guarantee you, if you go and check at 11:16, you'll see mass liquidations occurring. All right, so the price makes its way up, and eventually another small area of consolidation happens. And what do we see again during this period of consolidation? Market shorting. What's the other side doing? What's the bigger institutions doing? These internalizers doing? Well, they're buying those market shorts. They're creating the hidden bearish, bullish CVD divergence. And again, price moves up. Yeah. Now this is an order block, by the way. So what do we expect to happen when price comes back down here? Well, we do expect a reaction. Now we don't expect a reversal. All right, I don't expect a reversal at these points, but I do expect this will provide an opportunity to take profit on your shorts or scalp long. So that's the big one. Then you do have a smaller one here. All right, so you can note this one is notable because of the open interest increase and because of the CVD divergence. So you always want to make sure that open interest is increasing when you see that CVD diverging from price. That's very important that you see that. Is if the open interest is decreasing and the CVD is diverging from price, it's not really it's not a strong divergence. It's a type B. It's a Sometimes it can work, but it's not the best. You want to see that open interest increasing. And again up here, so as we breached above that old order block, so there was an old order block here. Yeah, I'll show you that on the charts. I think, yeah, it was the order block. Yep. So this comes all the way from Sunday, right? So that was a nice little order block here, and price touches it on a few occasions before selling off, and eventually we've run straight through it now. Yep. And just remember that we still have that right, and remember we still have that high time frame relative equal high, so that's going to be a drawn liquidity. But going back to going back to order flow, what we're going to notice here is as price ran out some liquidity and started rejecting, which is normal. What do we notice? We noticed that all of those new short position, the market shorts opening. As open interest increases, CFD going down, and this continues market shorting all the way down here. So we must remember that off-exchange market makers are likely the ones that are counterparty to these short positions. So their interest is to see price going higher, right? Because very, very rarely are they going to let so many shorts get off on profit. Okay, and they already have probably run out a lot of stops, right? Guys that have just moved their stops to break even, I suppose, they've already been taken out the market. Because price already did rally. It's really rallied. But remember, this is also part, so this is how liquidity is also engineered in the marketplace, right? So they will induce those market shorts in a way. And where do you think the market shorts have their stop losses? Well, those that are a little bit more brave, I suppose they'll put them above the previous swing high. Or those that are even more brave, they'll put it above the relative equal highs, right? Because that is resistance, right? And they think that if price goes up that high, that their trade idea is invalidated. Because if it's going that high, then it's probably going to go higher. Well, we know that's not the case. We know that price is just likely to reach into that liquidity before reversing. That is the more likely scenario. So we'll just note that for now. Towards the downside, we got three order blocks that are of particular interest. Okay, so you can mark those ones on your charts. As I said, I don't expect full out reversals on when price comes back into these order blocks, but they will definitely be institutional points of reference where you might want to take some profits, or you might want to scalp long, right? Remember, we had the liquidity void, and then these is fair value gaps. So these gaps are going to be also points of institutional order flow that want to be rebalanced. Cool. I think that's all I want to say for today. So I'll catch you guys later.